Welcome to another episode of the Prague Finance Institute podcast, where we discuss major global economic and financial trends with leading experts. Today, we are joined by Mr. Luca Paolini, Chief Strategist of Pictet Asset Management, which is part of the Pictet Group. Founded in 1805 in Geneva, Switzerland, Pictet Group is a privately owned Swiss wealth and asset management firm, specializing in investment management, wealth preservation, and private banking. Pictet Group is a leading European asset manager overseeing investments across a range of equity, fixed income, alternative, and multi-asset products. Pictet Asset Management serves some of the world's largest financial institutions and other clients. Joining us also is Mr. Michal Stupavský, Head of Research at PFI and Conseq Investment Management in Prague. Hello, Luca. We will start the discussion with the global macro themes before Michal takes over the discussion on global markets. So I will start with the US economy. It appears to be slowing down while inflation kind of remains sticky, and inflation expectations recently have been rising very fast, and also break-even inflation rates are rising. Do you think the US economy is heading towards stagflation?
Well, no, I think that we, as always in the when we talk about the economy, there are cycles, and the US in the last couple of years has done, I would say, not exceptionally well, but very well, especially relative to Europe, especially Europe, Japan, and China. What we are observing now simply is the consequence of a period of monetary tightening. Interest rates remain still quite high, and there is always a lag for economic growth to respond to monetary policy tightening. There is an increasing risk of tariffs, which for the consumer means higher inflation. And when you look also at consumer confidence data, US consumers are very worried about the future. Combination of higher inflation, weaker labor markets. Again, there is nothing particularly troubling in the US, but given that we are coming from a period of very strong growth, last year US growth was close to 3% when the expectation was for 1% or even lower. Well, then of course, compared to what happened the last few years, the general impression that the US is doing very badly. Clearly there is a moment of slowdown in terms of growth, especially in the consumer. Inflation, yes, is sticky, but the trend is still down. So I really believe that even if the risk of recession is still kind of there, I think we are just experiencing a period of slower growth without, the triggering a recession. So that's my assessment of the situation.
Today we have the Fed meeting result. And what are your expectations for Fed policy for 2025? How many rate cuts do you think we still have?
Well, again, this is another things that is very striking me. I mean, just a few weeks ago, the Fed was pretty much expected to do almost nothing this year. Now, the expectation for 2 or 3 rate cuts, probably the truth is somewhere in between. I do believe that the weakness in US growth will force the Fed to cut rates, but probably not enough in a way to trigger a significant rebound in markets. Let's be very clear on this. The US Fed is still a 2% inflation target, and we are roughly 1 percentage point ahead of that. And yes, economy is weakening, but it's still growing at a relatively solid pace. So I think that the room for the Fed to cut rates is relatively limited. But if this period of weakness persists, to me, there is no question that even if inflation remains higher, the Fed will have to cut rates. There will be a lot of pressures from investors, from the Trump administration to do so. And I think, again, what we have learned from the past is that the Fed is much more focused on growth than inflation. So if they have to make a decision, they will definitely go for growth. So I expect a couple of cuts going forward, but that's already priced in. I don't think that this would be a big surprise for markets.
Okay, thank you. We'll go back to the US in a bit to talk about the debt and the tariffs policy. To jump to Europe, the Eurozone has been struggling with weak growth for the last 2 to 3 years, and more specifically Germany. However, the new German government has recently announced significant defense spending and new fiscal stimulus programs. And also the EU has announced a large defense spending program. First of all, could these measures be enough to revive growth in the economy? And how do you see European debt, sovereign debt, the path of this sovereign debt if these measures are being implemented? And what would be the impact on maybe making a unified bond market or heading towards a fiscal union? What do you think about this new policy shift?
Well, the shift is very significant. It's very significant in practice, but also in terms of it's a cultural shock in a way. You know, we were everybody was expecting Germany to stick with fiscal discipline until recently, and you know, in a couple of months, everything seems to have changed. The German government effectively has announced the biggest fiscal stimulus in decades, effectively moving from fiscal austerity to fiscal expansion. There is also, by the way, the spillover effects that, of course, if Germany spend more, inevitably the rest of Europe, we feel less constrained to do so in case of emergency. So there is a positive, if you want, spillover effect. Does it change significantly the trajectory of growth? Yes, I would say. The numbers are massive. We're talking about 500 billion of infrastructure spending over the next decade. We are talking about effectively unlimited spending on defense. We have to see how this will play out, but these are really big numbers. So, but let's be very clear on this, right? The US economy is now almost twice as big as the European economy, or the euro area economy. In 2008, it was the same. So the gap that has opened is massive. This fiscal stimulus will not close the gap, but there is no question that probably this was the last occasion for Europe to change in a significant way. So it's a very positive step in the right direction, we will say that. I don't know if we'll stop this secular decline in Europe, but definitely give Europe a chance to at least reduce the gap relative to the US. In terms of public debt, let's be very clear. The US, I think, is in a much worse position than Europe. In a much worse position than Europe because government debt is rising much faster than in Europe. Fiscal deficit is still at 7%. We're talking about a US economy that is pretty much growing very strongly, and still you have a budget deficit of 7%, which is more than double what we have in the euro area. So with all this worried about the European debt, yes, we have an issue, but everybody else does it. The US, I think, probably in the worst position. China is also in a difficult position. So in a way, Europe has more room for fiscal expansion, basically thanks to Germany. If used wisely, I think this is very positive for Europe. But of course, there are risks of of the usual kind of European risk down the line. Populism is on the rise. You know, for some country, a rise in interest rate would be very damaging for the fiscal balance. So there is still a lot of unknowns. But I think what the German government has done, I think, is very positive. I think we'll reduce the gap with the US, but there's still a lot to do. And I don't think that, you know, public debt in Europe is the main issue. It's probably one of the issues in the US. For Europe, it's about innovation, it's about growth, it's about restoring a confidence that's been missing for a long time. And if you don't create confidence among businesses and consumers, you know, there is no way out. So I think it's the right decision. Let's see how it plays out. But I feel as European, encouraged by the events we have seen in Germany in the last few weeks.
We are also encouraged by this policy shift. But let me ask you a question about the ECB here. Do you think that the ECB would be acting in a way that would support this policy shift, meaning maybe it would be a bit more complacent about inflation and let inflation go beyond target, especially if we start to see some pressures on sovereign debt markets?
Well, I think the mandate of the ECB is clear. It's not going to change. They have a 2% target. They want to hit it. There is no question that, especially in the short term, this massive increase of fiscal spending can generate some inflation risks, partly offset by the strength of the euro in the last few weeks. But there is no question that inflation risks are probably on the rise. But for the ECB, the message is clear. They will stick with the 2% kind of target. They will definitely be much more cautious to cut rates going forward. And that's the message from the last ECB meeting. Before, the ECB was pretty much on an autopilot to 2% interest rate. Now they're adding some, the comments are clearly going in a different direction. And I think, as always, is about how much of this growth there will be leading to higher inflation. It's not obvious, by the way. There could be an increase in productivity that reduces the impact on inflation. There could be a stronger euro that will reduce inflation. So there are a lot of factors. But there is no question to me that the ECB will not completely offset, but will definitely put some brakes to, let's say, the fiscal expansion by a monetary tightening in case the inflation target is not met. Yes, there is a little bit of room, but not much. And I think one of the reasons why we don't expect, in a way, European growth to go through astronomical level is because there will be inevitably less monetary easing going forward. And that's obviously create some kind of issues. But again, the priority for Europe is to create growth. I wouldn't be overly concerned about the ECB. And it's good that the ECB, given the lessons of the global financial crisis, I think stand behind all members in case of shocks. And I think that's also, the market is aware of that. And so I think there is probably less actually reason to act. So I think I wouldn't be too worried about the ECB, but definitely they will not be as expansionary as they've been in the last few years.
Do you think that they would end the quantitative tightening program anytime soon? Because as a percentage of GDP, the balance sheet is now back to pre-pandemic levels.
Well, again, I think, we are living a different world than a few years ago. Now, I think the size of the balance sheet becomes less relevant. It was all about quantitative easing and tightening when interest rates were zero and inflation was also zero. Now, we are in a more kind of normal, traditional economic cycle. So yes, there will do something on that front, but I think the key now is and will be on interest rates, on the level of interest rates. And I think something that we also have to be very aware of is that in Europe, the banks or how much the banks lend to the private sector is a key variable. So it's not just the Fed, it's the entire banking sector that should, in a way, support this new fiscal policy. So I think this is something that we have to be aware of. I'm not, again, when you look at quantitative tightening, I don't think it's the key variable going forward. I think this was more like a debate for the past. Now I think the focus is on interest rates, and we want to see how much, that was your question, the ECB will be able to keep interest rate low in this new environment.
Okay, thank you. We're going to move to China. It is troubled with weak consumption spending, a bad property market, and deflationary risks. And they have attempted last year to restart the domestic demand, but it seems with the packages they have announced last year, they have failed. So can we see China repeating Japanese experience in the 1990s, where it's a prolonged period of stagnation?
I would say that there are similarities, right? An asset bubble, especially a property bubble, financed by excessive lending by domestic banks, is definitely a similarity with Japan. Having said that, there are two major differences. First of all, when you look at China today, relative to Japan in the 80s, China, in relative terms, relative to the US, is well behind in terms of GDP per capita. What does it mean? That there is much more catch-up potential for China relative to Japan. Japan at the end of the 80s was almost comparable to the US in terms of GDP per capita. China is much, much poorer. So there is much more upside there, more structural growth if you think about it. And the second one, which I think is it's also critical, that China is a much bigger player in terms of global growth. It is a much bigger kind of economy than Japan was back then. So I do think, though, that there are risks that the Chinese government, in a way, doesn't address the issues fast enough. There was the problem with Japan. They effectively allowed deflation to take hold over basically 2 decades, trying to reflate the economy, but allow even the Japanese yen to go through the roof, effectively offsetting the positive impact of fiscal expansion. China, in a way, has more room for action than Japan, has more power than Japan. I have to say that it's encouraging that the latest kind of decision taken by the Chinese government go in the direction of, in a way, supporting what? The consumer, because in China, the missing link of all this is the weakness of the consumer. And why? Because when you look at the consumer, their wealth, 80% of the wealth is in the housing sector, and the housing sector is struggling. And that's one of the reasons why the Chinese economy is not kind of growing as fast as it should. But I also think that with the appropriate level of fiscal expansion, monetary easing, and more pro-business economic policy, China has the potential not to grow at 5 or 6%, that's yesterday's story, but to grow at least at 4%, which it would be already a significant improvement. So we think that China now is stabilizing. We think that China, though, remains a risk for the global economy, but I see more the positive side. Again, we've seen Xi Jinping, for example, being closer to the business community, especially on the tech space. The DeepSeek kind of shock from a US point of view was very positive for, I think, the confidence in the business community in China. So a lot of challenges. Think about the level of debt in China is bigger than in the US. Demographics is very, very difficult. But again, China has, I think, the ability and the resources to get out of this and to effectively grow at rates above the US, but nowhere close to the level of the growth rate that China experienced in the past.
Okay, thank you. Now we're going to touch a very sensitive subject, an important subject that is going on in the financial markets, which is the dilemma that the US is facing. The dilemma between domestication of the economy, meaning like creating more jobs, raising the living standards of the Americans, but in the same time maintaining the status of the world currency reserve. It seems that there is especially with 125% of debt to GDP ratio, there is now a conflict between these two goals. It seems that the US has to choose one of the two. And now there is a talk about a certain Mar-a-Lago Accord, which aims to address these two goals and find a solution. One of the proposals is that the US will force foreign nations to buy its debt at a rate below market levels. What do you think about this talk and maybe the emergence of the new multi-world order?
Well, the fact that we have a debate on that, it tells you and it shows how far away we are from the Washington consensus of some decades ago. We are in an environment where effectively economic policy are becoming much more aggressive, more nationalistic in a lot of respects. And this creates all these tensions. And I think the debate we're having now on this potential new monetary order, global monetary order, I think is a testament to that. Now, when we look at the US and first of all, we need to be, it's not clear what the US administration is trying to achieve. The only thing that is really clear is that the US administration wants to effectively create or recreate a condition for a manufacturing boom in the US. The US has been losing the market share significantly in manufacturing. The US is leading in services, but in manufacturing effectively is punching below its weight. So the administration has a priority to create good manufacturing jobs in the US. And to do that, there are few options. The wrong one, I think, is via tariffs. They will allow, of course, some kind of job creation in some parts of the US economy. We will force some US, or well, let's say foreign countries to create jobs in the US. But in the long term, tariffs means protection, and protectionism means lower productivity. And if you're not productive, at the end of the day, you're not going to export, you're not going to create jobs. So I think I can see the short-term gain, but it's going to be a long-term pain to that. The most logical, and let's say more business-friendly solution to that is to allow the dollar to get weaker. So effectively, you can regain competitiveness by forcing your competitor via tariffs to be more expensive, or you can simply allow your currency to go down. And this, by definition, will make US goods more attractive for everyone else. What is the problem with that? That obviously the government is not able, and it shouldn't, fix the level of the dollar. So you need to have a policy in place that will allow the dollar to be weaker. And second, or as an alternative, you need to have other actors, countries, willing to coordinate a response. You know, in a way, the Mar-a-Lago Accord implies that the US economic partners will be willing effectively to play the US game. Now, I think what is interesting in all this is that on one side is clear, and Trump has expressed in the past the idea that a weaker dollar will be good. At the same time, as you mentioned, a weaker dollar will also inevitably challenge the view that the dollar is the only possible reserve currency in the world. So it's a very fine balance here. Our view, and I think what the US can realistically achieve, is to have a mix where interest rates or monetary policy is a little bit looser than it should be. Fiscal policy maybe not as expansionary as it is. And this should be enough, this mix, to take the dollar down. The dollar is still on almost any measure, between 10 or 20% overvalued. And so you need to have, and I agree that the dollar should be a little bit weaker, but you should put, in a way, an economic policy mix that is consistent with this goal. Now, from the US, we see a lot of, I would say, conflicting messages in terms of policies, tariffs, deregulation. It's a lot of noise coming up from the US administration. And I think what, by the way, can create the condition for a weaker dollar that we are seeing right now is a significant deceleration in US growth. This would be, in a way, not maybe what the US administration wants, but this could be the textbook and a traditional way to a weaker currency, effectively a weaker economy, lower interest rates, then you have less capital inflows, and then there is a rebalancing of the FX or the exchange rates. It's a very complex situation where tariffs also makes it much, much worse. You know, we are all expecting a stronger dollar because of tariff. Actually, we've seen exactly the opposite. Why? Because currency, at the end of the day, goes where the economies go. And with a weaker US economy, the dollar is going down. That's probably, you know, again, and it's interesting that US administration seems to accept the risk of recession as part of this kind of reallocation of resources, reshuffling the economy. But again, it's a dangerous game because markets can react in a very kind of quick way. And so I think, again, the US administration has to own the narrative, and now seems to be a little bit confusing.
We do agree with you, and to continue on your proposal, a reduction in the budget deficit and a weakening in the economy. Actually, the reduction in the budget deficit by itself is going to weaken the economy, but the economy is weakening on its own also. This may lead to a very nasty correction in the US stock market. And we know that a big part of consumption spending is coming from the wealth effect, from the financial wealth effect. What would be your view on the US economy going forward if they go with this path?
Well, I think you correctly pointed out that the wealth effects in the US is very important. You know, the US consumers and investors are pretty much the same. They're investing a lot in the stock market, much more than in Europe. So the correlation between the economy and the stock market is very solid. In fact, when you look at the latest consumer sentiment surveys, it's very shocking. I mean, when you look at the US consumer, they're expecting on one side equities to go down in the next 12 months. At the same time, they're expecting their finances to be close to the worst in 50 years. So it's really almost difficult to believe that the stock market is still close to record high, unemployment close to record low, and still there is a significant change in the risk and the perception, especially among the US consumers. Now, historically, what happened is that you have the market going up, then the economy starts to weaken, and with the economy starting to weaken, you have the stock market also falling. Now we may be in a different situation, like in 2000. When you look at the S&P, it's down 10% from the peak. We're not talking about a massive correction here, but there is a risk that, because of these fears, because of sticky inflation, high valuation, the market start to decline even more, and this can take the US economy down with it. I think, though, when you look at the fundamentals, there are no reason to believe that the US recession, even if there is one, will be particularly bad. The US consumer is in a very well position in terms of balance sheets. I don't think that even corporations, normally what triggers a recession is a big decline in investment. The private sector in the US business are really full of cash. But there is no question that, again, there is a strong correlation between the two, and it's possible that a decline in the stock market can effectively trigger a recession and not the other way around. But there is, again, you look at the US, we have seen the biggest underperformance of US stocks relative to Europe in 50 years. And this at a time where everybody was expecting the opposite. Again, another things to think about it, that when something is obvious in financial markets tend to go the other way. So a lot of interesting kind of events, I would say, in the last few weeks.
Okay, I'm going to give the podcast over to Michal, my colleague, and he will go over with the valuations and asset allocation. Thank you, Paolo.
Thank you.
Thank you very much, Andre, for handing over to me the interview. Luca, you have already started talking a bit about financial markets. I would like to state several key statistics regarding the performances since the beginning of this year. So the US dollar, based on the Dixie index, is down since the beginning of 2025 by approximately 5%. Regarding global stock markets, we have seen a pretty strong rotation out of US equities into Europe and emerging markets. S&P 500 is down by 5%, Nasdaq is down by 9%, and Magnificent 7 index is down by 16%. And regarding commodities, we have seen a continuation of the very strong rally in precious metals prices, with gold rising by 15%, crossing $3,000 per ounce threshold, and silver rising by approximately 18%. And today is Wednesday, March 19. So could you please comment on the key developments across the global financial market since the beginning of 2025? And if you were surprised by any of these major trends? Thank you.
Well, yeah, I was definitely surprised. Again, we have seen the biggest outperformance of European stocks relative to the US in 50 years. And I can guarantee you not a single person on this planet was expecting something like that in terms of this size. Is absolutely, off chart. Which, by the way, tells you one simple story for those that are investing in financial markets, that when a trade is obvious, everybody was on the same trade. With Trump, America first, tariffs is going to be bad for Europe, we're going to go for the US. It was exactly the opposite. Why? Because the expectations were too high. It's financial market is not about necessarily reality. It's the reality relative to the expectations. And expectations were completely against Europe. And I understand why. There is a war, there is a recession, no political leadership, an economy very exposed to global trade, being hit by tariffs. Everything that could go wrong for Europe was pretty much expected, and exactly the opposite, which I think is fascinating also from a purely kind of intellectual point of view. So this was the biggest surprise. What I think is important to say about this year is that if you look at what is going up, and you mentioned everything, almost all the asset classes, with one exception, gold, that are going up this year or that are outperforming has been typically sectors or styles or countries that has been doing better in the past 5 years. So there's been a total, if you want, the losers have become the winners at probably the most incredible time. So, you know, there was this idea that with Trump, you have to play safe, called US, tech, the dollar. And again, it was exactly the opposite of that. You know, Germany and China are the best market year today. China and India and the US, the worst. Exactly the reverse of what happened in the last few years. I think there was an element of, excess exuberance in the US. At some point, you know, 75% of the MSCI world was in US stocks. So even from a purely risk management perspective, if you're a European investor, you invest in an ETF, you find yourself, there is 75% exposure in the US, so in a country that has a different currency, far away from you, where the top 10 stocks, by the way, were almost 50% of the market. So there was an incredible level of concentration. Then you had this kind of weaker growth. And also, I think probably the fact that US administration, this confusing and conflicting policy at the end of the day has been particularly negative for the US, which was not supposed to be that way. So I think definitely the main story of this year is a big rotation away from the winners towards the losers, with very few exceptions. Gold is the obvious exception. The best asset year today, the best asset last year, the best asset over the past 5 years. And it's amazing because in almost every environment, you know, it's obvious to expect gold to do well when interest rates are cut to zero, but gold has done well even when the Fed was hiking rates. So there is a structural demand for gold, which I think highlight the fact that there is still a lot of investors are worried about inflation, about potential the credibility of central bank being questioned, and also geopolitical risk probably to escalate. But overall, I think the story is about rotation. And also when you look at the sector level, again, we have this massive rotation away from textile. You mentioned the Magnificent Seven. When you look at the performance, or well, the level, we're now back to basically the level a couple of years ago. When you look at valuations, we are at the same level 2017. So it's been a massive derating at a time when actually, when you look at the earnings of this company, hasn't really moved much. And so the question, what happened? What happened in the last, few months? It's not the US economy is crashing and your European economy is booming. What has changed, though, is the direction, the perception. Last year was, even until recently, was all about US doing well and Europe doing very badly. Now the US is doing okay, and Europe is improving a little bit. So if you want, the direction has completely changed. There's still a big gap in favor of the US, but the gap is shrinking very fast. And this kind of gap, by the way, is also this kind of recoupling, if you want, is also showing up in the currency market. The euro is getting stronger. And also bond yields in Germany are going higher. So it's not just a repositioning of equity investors away from US. It's something more, I think, structural in nature that tells you that investors are, in a way, upgrading the outlook for the European economy, and they're downgrading the one for the US. China, it's also interesting, right? Because until recently, China was effectively a place where nobody could invest. And now the situation clearly has changed.
Thank you very much. Elaborating a bit more on what you have just mentioned, could you please give us major highlights of your current tactical global asset allocation at Pictet, regarding equities, bonds, commodities, and alternative asset classes? Thank you.
Yeah, we are now pretty much of the view that the market is pretty much doesn't have a clear direction. We think the bonds and equity will deliver very, very low, maybe positive return in the next 6 months, but there is no clear direction in bond market and equity markets. We think that the rally in European stocks can continue relative to the US. The valuation gap more than halved in the last few months. So the case for Europe is not anymore on valuation, but on the ability of the European economy to recover. And we feel much more confident now, given that the indicator seems to be pointing in that direction. We also like emerging markets. Why? Combination of good momentum, weaker dollar, recovery or stabilization in China. I think there is a story there. When you look at sectors, our story is still pretty much to invest in sectors that are not affected by tariff risks, mainly financial, utilities, communication services. So in a way, stocks that have decent momentum, good earnings potential, not really affected by tariff risk. And then I think what is also important for us when you look at the fixed income space, we are now overweight US Treasury. I think that US Treasury have good value with interest, with bond yields close to 4.3, 4.4%. We are much more worried about European bonds, with ECB probably unable to cut much more, probably inflation picking up again, given that there is this fiscal stimulus going on. But we still feel that when you look at the fixed income space, the place to be is on credit, maybe more in Europe, and emerging market debt as well, where you still can get very high real bond yields and with, again, an improving outlook for their economy. We are still overweight gold, and I know the temptation is always to close that position tactically, but the dollar is going down, geopolitical risk, a lot of buying by central banks. They want to diversify away from the dollar. Everything seems to be pointing to a strong rally in gold that may continue, but I think at some point we may also trim our position. But for now, that's an overweight, and we are happy to leave it that way.
Thank you. And what is your long-term investment view and investment thesis on gold and silver? Do you think that every investor, even small retail investors, should hold at least a small percentage of their portfolios in precious metals?
That's for sure. I think, something close to 5% makes absolute sense. And even more so because we don't expect strong returns from equities and bonds in the next 5 years. So I do think that with gold, you have diversification. You don't have obviously an issue with supply on the metal. And again, there are some very strong structural trend in favor of gold. I think, without giving you a number, but, I'm not worried about 3,000 on a gold price. If you get close to 4,000, that's something that probably you have to change. But again, when you look at the fundamentals, they're all pointing in the same direction. To the only, I would say, reason to fundamentally change the case for gold, if there is a significant global recovery that basically create an environment where bond yields can go higher. So you have obviously the opportunity cost of holding gold goes up. You have equities going up. And then at that point, an asset class that give you no income would be less in demand. But we don't see this as a very high probability scenario. So we stick to go for the time being.
Thank you very much. And one follow-up question on gold. We have seen central banks, you mentioned that already, especially central banks from emerging market economies, that they have been buying physical gold like crazy since 2015-16. And this trend has significantly strengthened during the last 2 or 3 years. Do you think that as regards the global monetary system setup in the upcoming years, do you think that gold could again play a major official role in global monetary system again?
I find it difficult. I think when you think about the new, or let's say the global monetary system, I don't think it will be completely different from the old one. The only difference, I think, is that there will be more pressure from the US to allow the dollar to get weaker. I don't think that, there are clear alternatives to the dollar. I know that some people are saying that cryptocurrencies can be, in a way, an asset class that can, in a way, redesign the global monetary order. I'm very skeptical on this. Central banks are very skeptical in investing in Bitcoins, for example, for obvious reason. So no, I don't think that that we are going into a completely different system. What is clear, though, that in a world where is not any, let's say, unipolar, just around the US, is more tripolar, right? You have the US, you have Europe, and if you think about the global South, inevitably there will be multiple reserve currencies. So some more diversification away from the dollar will happen, but will be very, very slow. And that's what we have learned from history. It's very, very difficult for a currency to lose, in a way, the dominant role in the system. The dollar will retain that. There will be some maybe small challenges from this, but I do think that no, we're not going to go into a completely new global monetary system. I don't see the gold standard coming back. In a way, if you look at what we've seen in the past, I think it hasn't worked. It would be probably more, in a way, multiple reserve currency where the dollar will still be dominant, but not as dominant as now. But I don't expect, massive changes in the next definitely 5 or 10 years.
Thank you very much. Luca, one more question on US equities and in particular technology, information technology stocks, NASDAQ index, and once again, Magnificent Seven. This segment of global stock markets has performed tremendously well during the last several years. However, I personally believe that the valuations can be now compared to the 2000 technology bubble, at least as in several of these companies. So what is your midterm view on these information technology stocks in general and Magnificent Seven in particular, say for the next 2 or 3 years?
Well, I don't think that, I don't think it's a bubble. I think when you look also at a company like Nvidia or Microsoft, they are actually generating an incredible amount of profits. The profit margin is 60-70%. We're talking about stocks that are effectively generating a huge amount of profit, very different from 2000, where there were a lot of stocks where investors were hoping to make a lot of money, but they never did. So I think it's a different situation. When you look at tech now, very few stocks trade above 30, 35. So there is an element of overvaluation and potentially extreme bullishness on the future profit that this company can generate. Again, the DeepSeek story, in a way, shows that maybe there is an overinvestment in some parts of tech. I say maybe because it's still not clear. When you look at AI, clearly this is going to change our life, but they may not necessarily change the structure of the US economy or even generate profits forever. So I think we have to be very careful of that. So no, I don't think there is anything fundamentally wrong with tech. Now, after the decline we have seen in the past few months, evaluation, I think is pretty much in line with our fair values. So the real risk for me from the tech side is regulation. Now we are going, that's interesting, with the Trump administration going the opposite direction, but things can change. The risk is regulation on one side, and also potentially an overspend in tech infrastructure related to AI that, now is very difficult to predict, but it may end up being too much with lower returns on capital, or may actually can be the beginning of something very, really transformative. So I think given the current level of valuation, now after the decline that we have seen, I think we are pretty much fine. And we don't think that, again, we are nowhere close to, in terms of valuation, to the bubble period of 2000.
Okay, thank you very much. Now, one question on risk management for investors. I have always believed that risk management is as much important for investors as as trying to achieve high returns. So regarding the key global investment risks nowadays, which of these risks you think investors are somewhat underestimating at the moment?
Well, I think, one, in terms of risk management, one of the major risks is this high concentration of value in just a few stocks in the US. Again, this has been declining. The Magnificent Seven were 45% at some point of the market, now is 40%, so this is declining. Overvaluation of the dollar. At the same time, another potential risk is obviously cryptocurrencies that are becoming mainstream, but given the lax regulation, there is a risk there too. So there are a lot of factors that we have to consider of investors. And the rule is always the same: diversify away as much as you can, do your due diligence. I don't think that the risks today are higher than they were 10 or 20 years ago. In fact, I think that the global financial market is more solid. Central banks are more aware of the risks. But again, we have to be very aware of the risk, diversify, and that's one of the reasons why we hold gold. We need to have diversifying asset classes, not just maximizing returns. But this is true now, and it was true also 5 years ago and 10 years ago.
Luca, thank you very much. To wrap up our interview, our discussion, I have been personally following your investment research for many years. So for our viewers and listeners, if they were interested in your investment research, where can they find your pieces?
Well, on our website, Pictet Asset Management, also obviously on social media. But I would say if you go to our website, Pictet Asset Management, this is where all the information is. And of course, for those who have questions, they can contact me also personally. And thank you very much.
Luca, thank you very much. Andre,
thank you very much.
Observations from your side, Andre?
No, I thank Luca very much for this podcast. It was very insightful. And thank you, Michal, for your participation. I think we conclude the podcast, and Luca answered all our questions. Thank you very much.
Thank you very much. It was a pleasure. Thank you.
We hope to host you again. Thank you.
Thank you.
Bye.
Bye-bye. Thank you.
Bye.